What's up, guys? Welcome back. In today's video, we're going to be talking about a couple different strategies to do with Robinhood. Since they have earnings tomorrow after hours, the volatility will be high, and so the premiums will be really nice. Um, as far as earnings go, they're expected to beat earnings, but obviously we can't just rely on that fully. And then, I mean, the good sign is they have beat earnings last 6 quarters. So hopefully they can keep that rolling. Another thing I kind of want to talk about a little bit was just the pricing. Typically, I would do this on a stock that is honestly trading at, I mean, might be down 5% the past month, or could be up 5%. I still would feel good about it. But doing a stock on that's 25% uh, down in the past month, I mean, that just makes it, in my opinion, a lot easier. Past 3 months, down 36%. Robinhood, I think, is a great business to invest in. So I think it's no brainer to me. But yeah, let's get into it. The first thing I kind of want to talk about was optionstrat.com. That's what I'm using right now. Um, this is makes it super easy to see the position you're in, as far as max profit, break even, max loss. You can play around with the expirations or the date that it is. So, um, and then you can also see, okay, well, if I did it March 6th, what would be the outcome versus February 13th? So that's really nice. And it just makes it a lot easier to kind of figure out what you want to do. But yeah, the second thing I kind of wanted to get to was February, the expiration. Why I chose February 13th, so that'd be this coming up Friday. In my opinion, I don't really see there being a really big point to making it to March 6th. Like a month out, or March 13th. I think because of earnings, with the volatility, you're able to get a lot with very short term. So in a week, with a call, I could get 8%. So I don't know. In my opinion, I think that's a no-brainer. But so that's kind of why I chose February 13th, and that's kind of what I recommend around earnings time. Is you might as well. I mean, I don't mind doing. Typically I do 3 to 4 weeks. But around earnings, if it say my um, option closed beforehand, then I might do a different stock that has earnings in a week, and then I might just do it a week out. So that's kind of why I chose February 13th. Um, but now let's just get to the strategy. So right now I would be selling puts. So with the stock price of 86.56 and then having a put of 90, um, $90. So that basically means if at the end of February 13th, if it's above 90, well, the position closes and you get your premium. So you just made 5% or 8%, whatever it is. Um, but if it ends below $90, well, then that's when you would own the 100 shares or however many contracts. If you did 5 contracts, well, that'd be 500 shares. If you did 1 contract, that would be 100 shares. So in this case, it'd be 100 shares at 83.48. So you get even lower. That's kind of the whole point. Is as far as risk, if you're willing to buy it now, well, then you're able to get even lower if things don't go the way you want it. But if it does go the way you want it, well, then you just collected 5, 6, 7, 8%, whatever it is. So that's kind of why I love selling puts. Selling calls is very similar. That's the other strategy. Actually, first I kind of want to show you guys. So just on one contract. So if it ended above 90, you would collect $652, and so that would be on the one contract. So it kind of shows just how much you're able to collect, and that's just in 1 week. So that's pretty crazy. But the next thing I wanted to show you was selling a call, and that actually you need to buy shares. You have to buy shares ahead of time. So let's bring it down to 90. So this is kind of where it varies. My personal opinion, I would do a $90 call, leave some upside. It leaves roughly 350 for upside. Um, but you also get a decent break even. But if you're really bullish on it, I mean, I could totally understand it. Say at 95 or $100, then you just are chasing upside, which I totally get. And your break even is just a little bit higher. So there's kind of that you have to choose from. But other than that, I mean, typically, if it wasn't like earnings or a stock that's super low right now, if the stock price was 86.56, I would go with say an $87 call and just collect as much premium as possible. Collect that, well, in this case, it'd be almost 6%. Collect that 6% and have a break even of 82.16. Have the lowest break even, have high 6% a month, which is very good if you didn't know. Typically, it's like 10 to 12% that you might collect in a year if you're investing in the S&P. So it kind of puts in perspective of just how much 6% in 1 month or actually 1 week is. So that's kind of why I wanted to get this video out and just show you how much you can collect right now in just 1 week, and kind of it's not super risky in my opinion at all. It's because you if you were thinking about buying it at this price, well, you'd be right here. If it went down to say 80, okay, well now you just lost this amount. Well, but with selling a call or selling a put, whatever one, now you're just down this much. So you see how that can kind of give you another layer of safeness, I guess. So that's kind of why I love selling calls and selling puts and not just buying the shares, is because it gives another layer of protection. And so uh, yeah, I mean that's kind of what I had for you guys today. I just really wanted to get this out, not a super long video, but to just kind of show you the capabilities of this strategy and kind of uh, what goes into it. Other than that, if you guys give this a like and subscribe, I would really appreciate it. And yeah, I guess we'll see how earnings go tomorrow after hours.